Coming up now, we have Igal Cohen and Stephen Groslin, both principals at ASG Capital, and they're going to do a presentation today, Hunting for Yield Returns, why look to the subordinated debt market as an investment solution. Igal, I'm a minute early. Are you on the line or?
Yeah, I'm on the line right now.
And Stephen as well?
Hi, Michael. How are you?
Good, guys. Thank you very much. I'm gonna turn this over to you now, and I'm looking forward to your presentation.
Okay, thank you very much, Michael. I would like to present ASG Capital a little bit. ASG Capital is a US regulated asset management firm based in Miami, Florida. ASG Capital is represented in Europe for its UCITS European Mutual Funds by Alter Domus in Luxembourg, a regulated management company. We launched as well in June 2019 a limited partnership investment fund with the same investment strategy and an additional leverage component as the fund that we currently manage in Europe since 2014. The name of the fund is ASG Enhanced Income Fund LP. We have also been advisors to institutions such as Lixor Asset Management, which is part of Societe Generale Group, on subordinated debt investment strategies for many years. We also replicate the same investment strategy in separate managed accounts format with multiple custodians in US and Europe. And ASG expertise, what it is, we focus on income generating investment solutions with a special investment focus on international subordinated debt assets. I would like to provide you a little snapshot of the fund advisory team. My partner, Stephen Groslin, and I have a combined experience of 45 years in the subordinated debt market. I was myself in charge of the sales trading activities of subordinated debt instruments in France and also in the US for household names, Prudential Securities, Wachovia, and Jefferies, advising mainly institutional investors in this asset class before launching ASG Capital and making an investment vehicle available for investors in the middle of the financial meltdown in 2009. Stephen?
Thank you, Miguel. Thank you for the introduction, and hello to you all. Thank you, Michael, for organizing this event. I'm not going to bore you with my CV, as it goes back quite a bit. I've been trading fixed income products and interest rate products since the early 1990s, both in Europe and in the US. And the thing we bring to the table with Igal is the time, in the sense that we've been around quite a bit now in different market conditions. We've lived through double-digit interest rates, now down to negative interest rates in Europe and zero interest rates in the US for some time. And also the fact that we've operated both sides of the pond, so we have a know-how to bring to the table as far as that's concerned going forward. Miguel, back to you.
Now we will introduce the subordinated debt instruments and present a little bit the subordinated debt market briefly. So what is the definition of the subordinated debt instruments? It's essentially a financial debt instrument which ranks behind the senior debt for reimbursement in case of a bankruptcy of the corporation. And there are different types of subordinated debt instruments depending on the geographical space that we are operating on. In the US, the traditional preferred securities, and in Europe, the junior subordinated debt, the hybrid corporate bonds, the additional tier 1 bonds, or what we call the contingent convertible bonds, COCOs, and for the insurance sectors, the restructured Tier 1. Additional Tier 1s are the new subordinated debt format for banks in Europe, and the RT1, the restructured Tier 1, is the subordinated bond format, the new compliant subordinated debt format for insurances in Europe. For accounting purposes, the subordinated debt is considered as part of the capital structure of a corporation. It essentially gives a corporation the opportunity to raise capital without diluting the voting rights of ordinary shareholders. It essentially enables a corporation to improve its gearing, or what we call the debt to equity ratio. It is considered an alternative fixed income debt market. It is considered a niche market, as the instruments are mainly issued by large corporations. And it is considered also a small fixed income market compared to the high yield or the emerging market in hard currency, both significantly larger. The estimated size of the subordinated debt market worldwide is around $1.1 to $2 trillion, which is quite insignificant in the fixed income world. The instruments that are issued for the subordinated debt market are issued mainly in US dollar or in hard currency, US dollar and euro. And it is considered a very old market in the US. Europe starts to develop the subordinated debt market with the advent of the euro in early 2003-2004.
So if you're looking for a revenue stream from a financial instrument, the subordinated product is the investment for you. But for certain investors, there's a certain negative perception around this particular product with regards to the risk. As Igal mentioned just a second ago, the instrument ranks behind senior debt in the case of the bankruptcy of a corporation. The instruments are sometimes complicated because they're different moving parts. There's a call, for example, that could be at the discretion of the issuer. It's quite a small niche market, and there's some limited number of players that operate within it. What we think these perceptions are misplaced. First of all, when you look at the subordinated debt instrument, you need to look at the balance sheet as a whole, because for an operation to keep going and operate its business moving forward, a corporation will pay all its coupons, including its subordinated debt first, before paying dividends to its ordinary shareholders. So it's fundamental for the corporation issuing this kind of instrument to pay the coupon on this particular and ensure the revenue stream on this particular instrument. Secondly, most of the issuers are generally large corporations, and if they're large corporations, there's a lot of financial analysis to have a view on the quality of the balance sheet that's supporting the subordinated instrument that we're talking about. Thirdly, there's, the rules have changed, especially with regards to the banking sector, notably in Europe. And in fact, the senior debt holders are as exposed as the subordinated debt holders in the case of a bankruptcy type situation. And yet the yields are quite different. So we find if you're exposed to the same kind of risk, why not pick up, if you can, that particular yield going forward? Generally, well, we've seen it once again with the intervention of the central banks over the last few months. Funding, the windows are very open to large corporations from the central banks. So funding is very easy for the larger corporations, but to raise capital through the subordinated debt space is a little bit more complicated. And that's why, as far as the corporations are concerned, they tend to approach this on a strategic basis. It's important for them to keep the favor of the investors as much as they possibly can, and to entice people to invest on this kind of instrument. They will constantly pay a premium to attract investors to it. So as a consequence, in a world where interest rates are basically at zero everywhere in the hard currencies, this is an instrument that's looking more and more popular. It was at a time a niche investment, a very limited player investment, but as investors are chasing yield, they're looking more and more to subordinated debt to invest. So the way we look at it is the balance sheet is really the risk that determines the quality of the subordinated instrument that you're buying. That risk, if you're uncomfortable as an investor having too much of that particular risk in front of you, it can be diluted through a portfolio format. And that's what we do at ASG on a well-diversified portfolio. And we think that there's the returns justify this kind of asset being looked at relative to senior debt, because basically the returns on senior debts have completely disappeared now, even in the US space.
Now we will present the competitive investment advantage of the subordinated debt instruments. There are essentially two main advantages that make the US dollar subordinated debt market an interesting investment space to look at. Number one, there is a high current carried yield. As Stephen mentioned before, in a world of very low interest rates, the carried yield on subordinated debt is between 4 to 6% for large systemic, household, and blue chip corporations issuing these bonds. And the yield available on subordinated debt can be up to 3 times those available on senior debt for the same issuer. And the second advantage related to this specific asset class is the capital gain potential. There is a unique added value relative to traditional fixed income instruments for several reasons. Number one, the regulatory advantage. There is a capital gain potential on discounted non-compliant bonds callable at par, for example, especially in the European space when we changed the compliant format from a subordinated debt legacy into an additional tier 1 format in Europe. There was a lot of potential capital gain on the subordinated debt legacy paper. Number two, there is also a monetary change advantage. The capital gain is possible thanks to the coupon structure of the subordinated debt bond. For example, bonds with different coupon structures, floaters, fixed to floaters, and fixed, permit an optimal positioning on the interest rate curve. And this is not something that we can usually find in the senior debt supply of fixed income instruments. There is also a supply constraint situation. Few instruments are available out there, and there is an important international investor demand, especially now as the world, Europe, Japan, and now in the US is starved for yield. For example, European bank issuers are no longer issuing new US dollar bonds because it's significantly cheaper for them to issue now in euro, better than any other currency. Also, there is also a very important point related to the subordinated debt instruments that are becoming more and more popular with investors. For example, additional tier 1s and restructured tier 1s, which are now the new compliant format of subordinated debt for banks and insurance companies in Europe, were initially representing an unknown animal in 2013. It is now a very sought after instrument. Today, there is more comfort from investors on this specific asset class compared to the launch of this asset class in Europe in 2013 and 2014. There is also a capital gain component through arbitrage opportunities between international issuers. Example of a situation that occurred in the fourth quarter 2018. We overweighted the portfolio in European issuers in the middle of the yellow vest situation in France, obviously investing in household names in US dollar of European issuers. And there was some pickup of spreads, attractive pickup of spreads in Europe versus US. So we consider within ASG Capital that we have a strong expertise to pick up relative value investment thanks to our transatlantic DNA, US and Europe. And the last point is that there is a performance potential through a dynamic use of leverage. The cost of leverage is very low now, especially with our custodian interactive brokers, and we optimize the use of leverage with an adequate risk management in place. Stephen?
Stephen, you're on mute. Stephen, you're on mute. So Yigal, why don't you continue the presentation if you can? We'll reach out to Stephen.
Tu m'entends?
Oui, je t'entends.
T'as pas...
Je suis complètement déconnecté.
Ok, tu peux... Vas-y, c'est bon, c'est à toi.
Which slide? Hi.
Yeah, Stephen, it's your turn regarding the possible drawbacks for the investor.
Yeah, I'm sorry, I got disconnected. So there's some possible drawbacks on this subordinated assets space. For certain investors, and especially the larger players, it's a niche market and it's not adapted for those particular funds. Secondly, these instruments, you really need to be looking at an investment period of minimum 3 to 5 years. You're really looking at the revenue stream, so it's not adapted for short-term investments. The instruments themselves are complex. There's a lot of moving parts. Some are forward-looking, some are backward-looking criteria. The subordinated debt instrument, as it ranks close to the equity part of the balance sheet, is part of the capital structure. The analysis needs to be maintained on the equity and the fixed income side. In addition, as far as the liquidity is concerned, if you want the assets, you need to be patient to source bonds at the right price, and it's the same case coming out of the assets. You need to be patient to be able to sell them at optimal levels. Some investors don't like the fact that the instrument might not be investment grade. The balance sheet could be investment grade, but the instrument sometimes is non-investment grade, and that can be an issue for certain investors from time to time. So the way we look at it, if you want to maximize returns and get the best out of the asset class, is to look at it on a 3 to 5 year investment horizon. The subordinated assets do require a lot of analysis prior to intervening, but also as an ongoing analysis to make sure that everything's going smoothly with this particular assets class. We also recommend, as we are specialists in the field, you can always call upon people like ourselves, other specialists in the market, to help you construct a portfolio or to give your investment over for our managers such as ourselves to be able to manage that for you. I'll just touch base on the possibility of constructing your own portfolio with individual positions relative to the use of a fund vehicle. As far as an individual position is concerned, in the US, it's quite retail friendly, but in Europe, that is not the case. The minimum investment is $200,000 generally to acquire subordinated debt bond. And as a consequence, if you want a well-diversified portfolio, it can be an issue to do that for a retail investor without a certain amount, a certain financial footprint. A fund, on the other hand, does give you access to a diversified portfolio from a minimum amount of maybe $1,000, as is the case with us, $1,000 or €1,000 to be able to get a well-diversified portfolio going forward. We also find that the fund format does enable us to optimize all the elements that we've mentioned before. We talked about the regulatory advantage, we talked about the interest rate advantage, and because the funds are generally bigger, with intervening regularly in the market, that enables to constitute more value going forward. I'll just make a point on the passive relative to the active funds in our investment space. The passive funds we find are cheap and nasty, and they're not at all adapted to this particular asset class. Why do we say that? Because the passive funds lack the flexibility and nimbleness that is necessary to maximize performance and minimize risk. So they're not at all good at maneuvering in stress situations such as the beginning of the year, as far as that's concerned. Secondly, they're unable to adapt to, let's say, positioning for more prudent or aggressive style going forward. It's always the same kind of format that's predetermined by the investment vehicle. They're not very good at bond picking. They tend to go for the large benchmark issues, so they can't look out of the box because they're not programmed to be able to do that. So on the relative value trades, they're not very good, and they don't take account of the regulatory changes that could take place. So we find that on the balance, a passive fund for a niche investment space such as a subordinated asset class is not really the appropriate way to go. For the retail investor, there is a choice to constitute his own portfolio, his or her portfolio, or there is the active fund with the specialized know-how that is brought to the table on that front. We'll conclude now. So why look to subordinated debt as an investment solution? The subordinated debt offers higher, on a relative basis, higher yield returns. We're talking about 4 to 6%, which stands out like a sore thumb in a world where there's zero interest rates everywhere. There's also the performance potential on this kind of instrument to get carried yield on the one hand, but also the capital gain option that we talked about earlier on. The world is starved for yield. Michael's mentioning earlier on that there's an aging population that needs to generate a revenue on the investments that they're doing. So as far as that's concerned, this kind of asset fits very well in portfolios for those kind of investors. So the demand is just going to increase over time for this kind of instrument. So there are not too many places to go, and the subordinated investment space is one of them.
In addition to what Stephen just mentioned, we consider that strong and large balance sheets generally will honor their subordinated debt and their coupon in good and bad times. It is a strategic and fundamental requirement for large corporations to maintain their access to the subordinated debt market in order to be able to raise fresh capital when they need to. The underlying credit risk of holding the subordinated debt of large, systemic, household names, blue chip corporations is therefore limited. This is not the case on high yield, for example. Their credit risk, their credit default risk will rise as the economic cycle turns down, and the COVID situation is the perfect example. This is not the case for emerging market bonds either. These issuers are exposed to local geopolitical risk, bad neighborhood, and potential economic downturns like what happened in Q1 and Q2 2020. Furthermore, the drawbacks of complexity, liquidity, access to world issuers, time horizons can be managed productively to create value through an actively managed fund format. A passive fund lacks the nimbleness to create value and minimize risks. It is also considered essentially a niche market, becoming more and more popular with all types of US and international investors. I remember in my days with Prudential and Wachovia, when I was working even with the investors, they didn't know what means preferred securities. Now there is there is a jurisdictional format under the AT1 and RT1 market in Europe that is very well known, but by not only the institutional investors, but also the high net worth individual investors in the European space. Also, the subordinated asset class of household issuers is also a liquid investment space. And this is a very important point. The yield it provides compares well to illiquid investment strategies like the private markets. In addition, there is an option to use leverage because the subordinated asset class allows it, which enhances the current yield potential of the portfolio. And again, we use the leverage in a dynamic way. For example, at the end of February 2020, we removed completely the leverage because of the liquidity risk that was embedded in our portfolio. So we have a dynamic use of leverage for the benefit of what we call a patrimonial approach, a conservatively balanced approach of investment. In conclusion, we consider that ASG Capital has a strong expertise to pick up relative value investment thanks to our transatlantic DNA, US and Europe. We talked about that before, on this specific asset class of subordinated debt instruments in order to optimize the performance and manage the risk in an appropriate way with a conservatively balanced approach. We open now the floor for questions you might have.
Y'all, you have a couple of questions. First question is about liquidity, which I believe you covered during the presentation. But if you don't mind just answering this person again, can you talk about the liquidity of the strategy?
The liquidity in this strategy, this portfolio is completely liquid. We have in the European mutual funds that we manage in Europe, there is a daily NAV, there is a daily net asset value on the fund, and the liquidity is there to satisfy the potential redemption on the fund. The LP format in the US has a monthly NAV, but the portfolio is also liquid. It's a mirror of what we have in the European fund. Those assets are liquid. They are traded in an exchange for the preferred securities in the New York Stock Exchange, and also in the OTC market for the bonds format of subordinated debt instruments. So we have no problem whatsoever in terms of liquidity. What could happen is a situation like at the end of February or March 2020. There was what we call a liquidity crisis. It happens sometimes in a situation like the Lehman crisis, or this COVID situation was the perfect example. The liquidity was there even though we had the liquidity crisis in March 2020. In other words, you might have some huge spreads between the bid and ask, but you have the liquidity that you are looking for. So there is no problem of liquidity whatsoever. And the other point that is very important in our investment process is that we do not invest in tier 2 and tier 3 companies. We invest in tier 1 companies, the household names, the Fortune 500s of this world, the big market capitalizations that have recurrent cash flow structures. So we have no problem in terms of finding the liquidity for those issuers that are very well-known issuers, many OECD markets with an epsilonic exposure into the emerging market space.
So the next question you have is from a registered investment advisor out of Florida. And I believe what they're trying to ask has something to do with you comparing ASG versus one of these like mega funds that you compete with in the space, and the differentiation between somebody who's got more flexibility and is more nimble versus a large institutional portfolio, and what the difference is between the return profiles for your fund versus a massive massive fund.
That's a great question, and this is a very interesting question, and this is where we think that the nimbleness and the flexibility of our investment strategy has a lot of value versus any typical passive fund. The passive vehicles tend to deploy funds when received. As a result, they tend to over-concentrate on subordinated benchmark issues because of the strong availability of these bonds in the marketplace. The active funds can focus on absolute and relative value, the use of timing for optimal intervention, and also balance the risk to limit the over concentration of assets in a specific portfolio. So for example, to be very concrete in our investment process, we can, for example, buy scrap amounts that represent some value in our portfolio as we are nimble and flexible. If you take a name like Fidelity that has, let's say, $5 billion of subordinated debt instruments in its portfolio, do you think that it will create some value by buying scrap amounts in the market for their portfolio? It's more a back office issue for them than a value added for the portfolio. So they would not take into consideration some scrap amounts in the market. So the flexibility that we have as being small and nimble and is providing a lot of value versus any traditional benchmark fund that has a passive investment strategy in this space.
This was very interesting. I really enjoyed your presentation today, and you and Stephen did a great job. I want to thank you guys for coming back and updating the our global investor community, and we wish you the best of luck.
Thank you very much, Michael, for having us today.
Thank you, guys.